All right, if you're a tech investor, today was, well, it was probably a rough one. Mine too. There's so much noise and panic out there right now, so my goal here is pretty simple, to cut right through it. We're going to take a clear, step-by-step look at the fundamentals behind what just happened. No hype, just the numbers and the analysis. This is the number that everyone's talking about. A drop of over 12% on the KOSPI in a single day. Now, to put that in perspective, we haven't seen it drop that bad since September of 2001. This was a truly historic sell-off. So here's how we're going to break this all down. First, we'll look at the shockwave itself. What actually happened today. Then we'll dig into the bigger picture, focusing on three key ideas. One, that the rally we saw was built on real earnings. Two, that current valuations look pretty disconnected from those earnings. And three, how this all fits into a much larger multi-year tech cycle. And then we'll wrap it all up with the key takeaway.
Okay, so first things first, the March 4th shockwave. Before we can analyze anything, we have to really understand the anatomy of what just happened, the market's worst day in over 20 years.
So, what kicked this all off? The immediate trigger seems to be external. A lot of fear and panic spreading about a potential conflict in the Middle East. And that fear just led to this massive sell-off. The KOSPI plunged below 5,100. And get this, it wiped out more than 800 trillion won in market value in just 2 days. And as you can see, the heavyweights got hit really hard. Samsung down almost 12%, SK Hynix down over 9%. So with all that chaos as the backdrop, let's get to our first key point. Before this crash, the market had an incredible run, almost touching 6,000. And the popular story, the narrative, was that it was all just a hype bubble. But we have to ask the question, was it really just hype, or was it built on something a lot more solid? Well, this analysis suggests that while the perception was definitely hype bubble, the fundamental reality was that the rally was being driven by something very, very real, just staggering growth in corporate earnings. Now, this is where it gets really interesting. This slide shows something kind of counterintuitive. We all saw the KOSPI index hitting all-time highs, right? But at the same time, the market's price-to-earnings multiple, which is how we measure if something is cheap or expensive, actually went down. So how is that even possible? It's actually pretty simple. The profits these companies were making grew even faster than their stock prices did. So on a fundamental level, the market was actually getting cheaper. So where did all this incredible profit growth come from? Well, you can think of it as the engine room. Just look at these two companies, Samsung and SK Hynix. Their combined net income is projected to leap from 85 trillion won last year to an estimated 300 trillion won this year. That is not a small jump. It's a complete explosion in earnings, and it's what powered the entire market higher. All right, so that brings us to our second key point. This incredible earnings growth has created what some analysts are calling a huge valuation disconnect, especially after a day like today. So let's take a closer look at what these companies are earning versus how the market is pricing them right now. This table really lays it out. Based on those massive 2026 profit estimates, Samsung is now trading at a price-to-earnings ratio of about 8. And SK Hynix, it's even lower, around 5 times earnings. I mean, for global tech leaders generating this kind of cash, those are extraordinarily low multiples. And to put that disconnect into perspective, here's a little thought experiment from one analyst. If Samsung were to be valued at a 20x PE multiple, which, by the way, is still pretty reasonable compared to other global tech giants, its stock price wouldn't be where it is today. It would be up at 500,000 won. And the same logic for SK Hynix really drives the point home. If you applied that same 20x multiple, its theoretical stock price would be somewhere near 4 million won. Now again, these aren't predictions, they just show the huge gap between where the market has priced these stocks today and a valuation that's based purely on this year's expected earnings. But that raises the big question, doesn't it? And that's our third key point. Are these massive earnings just a one-time thing? Is this a temporary spike in demand? Or are we actually seeing the start of a much longer structural shift in the whole tech cycle? Well, the evidence seems to suggest this is not just a 2026 story. For instance, SK Hynix has reportedly sold out its entire memory production for this year already. And not only that, they're already selling a big chunk of their 2027 production. This kind of forward demand is what leads analysts to believe that this strong earnings performance is going to continue at least through the end of next year. And if we zoom out even further, the picture gets even bigger. You've got both NVIDIA and Google making the exact same, pretty stunning projection. They see computing demand growing 1,000 times over the next 10 years. 1,000 times. That suggests the driver here isn't some short-term blip,
but a massive, decade-long structural trend. So the argument here is that we're seeing a fundamental change in what's powering the market. Back in the 2000s, the cycle was all about China's demand for industrial materials. But today, the new engine is this U.S. megatech-led cycle, with South Korean companies basically acting as the essential suppliers for this whole new era.
So let's bring this all together for our key takeaway. What all this analysis really highlights is this clear tension that we as investors have to navigate. The tension between the very real short-term fear that we saw in the market today and the long-term fundamentals that we just laid out.
So I'll just leave you with the question that I think we all have to grapple with now. After a day like today, is the market defined by a crisis that's driven by fear? Or is it defined by an opportunity, one created by a huge disconnect from the underlying earnings and fundamentals? I've laid out the framework here. The conclusion? Well, that's for each of us to decide.